Please welcome to the stage our next session's moderator, Matt Burton, partner at Backbone Asset Management. He's joined by panelists Noah Cornwall, Chief Technology Officer of Defense, Hussein Ahmed, founder and CEO of Limited, Carl Vogel, General Partner at Sixth Man Ventures, and Bernardo Breitz, CEO of Trace Finance.
All right, thanks everybody for coming to this panel at the end of the day. We know that drinks is coming up quickly, so we're excited to go through quickly. We're going to kick it off with just a quick intro from each of the panelists. And then we're going to jump into a question that is super interesting, which is how much of fiat payments has been eaten by stablecoins so far. And the really interesting part is when we started out this conversation 4 months ago, our estimates were very different than they are today. And many on the panel think we've already crossed 1% of stablecoin adoption versus fiat, so we can sort of jump right in. But first off, I'm going to hand it off to Noah to give a quick intro, and then we'll go down the line.
I'm Noah. I'm the CTO of Defense. We're a wallet as a service company, and we provide a really powerful infrastructure layer for companies like Bridge, Iron, and like the payment space, and then like Zodi on the custody side. So really, high-level APIs to help move transactions through. And we love stablecoins. Stablecoins are awesome. They've really been great for business for us and for businesses building on top of us.
Hi everybody, my name is Hussein. I'm the CEO and founder of Limited, which is a global digital bank based out of San Francisco and operating globally based on self-custody stablecoins.
Hello to all 10 of you that are in the audience. My name is Carl Vogel. I'm a general partner at Sixth Man. I saw somebody waving. That's great. General partner at Sixth Man Ventures. We're an early stage crypto venture fund that leads rounds from pre-seed through Series A. Check sizes 500K to 5 million. We focus historically on the application layer, so the companies that are consuming block space rather than companies that are creating more block space.
Hello, I'm Bernardo Breitz, CEO of Trace Finance. We power all the stablecoin and payments companies down in Latin America, mostly Brazil. And I'm super excited to talk about this topic. We actually have a couple really interesting discoveries to explore here.
Yes, so to kick it off and set the stage, so again, these are estimates and they're the best that we can come up with. But right around $200 trillion of USD is used for commercial cross-border trade per year. If you look at like the Visa dashboard today on stablecoins, you'll see that it's around 30 trillion. They have sort of an estimated volume of about 6.5 trillion of the 30 that's actually being used, in for like basically think not DeFi as the use case on that side. And so this has been growing quickly. If you've been having any conversations at this conference, it seems like every startup is seeing exponential growth right now within this space. And so the first thing we wanted to just chat about was, would love to hear from each of the panelists on where are they sort of seeing the growth come from, both either on a consumer or business side or on a regional side, which countries. So we'll start off with Noah.
Yeah, I think we've really seen a lot of growth on the business side. And I think kind of first, like LATAM really picked up quite a bit. In LATAM, you take a lot of currency risk if you're in like a local currency. So getting a stablecoin payment like USDC can make a lot of sense, especially if you're working with like a US company who's able to pay in like in that flow. And then beyond that, really in the last 6 months in the US, like pretty big changes, a lot of growth amongst businesses. I think one of the like key components is like as a business, if you can send $100 or $1 million for like a couple pennies, it doesn't really matter the transaction size, then why wouldn't you just go use this rail? So on that front, we've just seen a ton of growth. And the business is building on top of us. Obviously they've seen like a ton of growth too. So really that like US LATAM has been pretty big for us. Europe, definitely see like a lot of business there too. But that growth on like the like North and South America side, it's just been pretty exponential.
Well, let's go to Bernard real quick. I mean, I know we've talked about the LATAM. Just to continue, I mean, can you tell us a little bit more about what you're seeing in Brazil?
Yeah, for sure. So we only deal with businesses, but we do a lot of B2, B2C. So we work with the local in Brazil, and we power a lot of the cross-border movements. And to give you perspective, our volume grew from first half of last year to first half of this year 41 times. And
that was 40 times?
Yeah.
40 times, yeah.
And back in September, we had 7% of our settlement volume in stablecoins. Now it's 45. So there's big adoption in emerging markets. I know we talked about a lot of people not seeing the real growth like in the US or in Europe perhaps, but in Africa, in Latin America, businesses are really considering stablecoins to move money across the globe. On the consumer side, I think that of course you have adoption with exchanges. I don't necessarily think you have most consumers now using stablecoins to move money to other countries. But I think that there are a lot of companies like Dollar App, like Nomads, and other like remittance companies that are exploring stablecoins. So even if users at the end of the day are not thinking of using stablecoins, their money is being moved by stablecoins at the end of the day.
Yeah, so even if the consumer doesn't realize the money is moving on stablecoin rails, it is. Hussein, do you want to talk about other regions?
Yeah, I think actually even to Noah's point, despite like we're based in the US, I don't think we are targeting US customers per se, because like obviously there's no point of like competing with Chase and Amex and Wells, and those guys are not really doing a bad job. I think it's actually the customers outside the US who actually was going to be the ones actually in need for USD access. Some of those countries, obviously Argentina, for example, like 100+ inflation, so even having your business treasury in USD, that's like a big win in itself, like let alone like the actual benefits and perks that you get from like banking with us or somebody else. As much as honestly, like yeah, your money is evaporating basically because of inflation. Some other countries like Egypt or Turkey and like some other Lebanon and so forth also have like basically government regulations that can basically control how much you can get USD, how much you're allowed to spend in USD, to control inflation, to control some other kind of economics on that side. So that would be basically the emerging markets to be more definitely looking for like a solution for that problem. And I think also, at least like from my perspective, also being from fintech banking before crypto, the experience in crypto has been very complicated in a sense, like the whole passkey, passphrase, wallet, self-custodial, centralized custody. So obviously, if you're talking to somebody who's like just like exporting avocados to the US from Mexico, this person obviously looking for a bank alternative, not really as much like why would they have to deal with complexity. So hopefully, if we drive the UX experience kind of access to those chains / stablecoins without having the complexity of crypto, hopefully that can unlock even mass adoption beyond the typical crypto persona who's actually even able to use those chains at this point.
Yeah. Yeah, I mean, Carl, from the venture side, it's not normal for us to see technology get adopted in the emerging markets first, you know, and sort of the developed markets later. I mean, what are you seeing from your seat right now?
Where we're seeing a lot, so by the way, I want to address one thing you asked about earlier, and then I'll go into that question. I'm going to be a little contrarian to start. In where the opportunity is for stablecoins, the biggest opportunities right now are outside of payments. It's really in capital markets, and the reason I say that is if we go do a $20 million trade with an OTC partner, like what if it's a crypto asset, you know, USD is the other side of that trade, and so the amount of coffees that you need to sell in order to generate $20 million that any one of these funds can do in a day, if not like in an hour, that's where the most rapid growth I think is going to continue to be. A lot of this is sort of sequestered under the B2B side for payments in the capital markets more specifically. But you know, generally that is fairly well sophisticated at this point, and like people in crypto already know how to send and receive to OTC desks. It's pretty well figured out. I think the real opportunity is on the retail side, which is where a lot of the conversation has been so far. The biggest things I'm excited about is like checkout products. So specifically, how do we get users to engage with crypto, and how do we make it really easy for merchants to start accepting crypto that comes from all these different chains? I was just reading the blockchain report that was released today by Artemis, and it showed, you know, for some of these countries, there's 4 or 5 different blockchains that have a major share of stablecoin adoption. And if you're a merchant, you're like, I just want to be able to sell this person a coffee, and if they have stablecoin, but how do I accept all these different blockchains and have different QR codes? So figuring out who is going to solve the point of sale or e-commerce checkout problem for payments is where I see one of the biggest venture opportunities at this point. Of course, there's going to be many more late-stage opportunities, for example, like what Trace is doing and other companies, and those are going to be for very, very large traditional institutional investors to get involved. But for where can a company go from 0 to 100, it's how do I touch the user in a compelling experience that's radically better than them trying to use Binance Wallet or MetaMask or any of these other products that exist today.
Yeah, I mean, I think one of the themes of today has been there's a lot of infrastructure upgrades going on. You know, this morning I was reading the Utila release, and they're sort of optimizing their wallet architecture specifically for payments. And then we were talking before, and I wanted to touch on the Ethereum upgrades that are going on around stablecoins. Noah, can you give a high-level upgrade?
So the Pectra upgrade went out a few weeks ago, and it had EIP 7702. And personally, I've just been waiting for this for so long. You know, I like to use my dad as an example all the time. I love my dad. He's in his late 60s. But if you told him he had to go buy shares in Bank of America to go move his money, he would just be like, well, I'm not going to use Bank of America, right? Like, it just wouldn't happen. So with the IP 7702, it takes the smart accounts like 4337 that came out, and huge upgrade. Now an EOA account can turn itself into a smart contract, and another account can pay the fee. And what this really unlocks is a user, they get 100 USDC into their account, they want to go make a payment at the retail app, they sign a user up for it, the retail app could pay the fee, another wallet provider could pay the fee. They're just operating with, I've got 100 USDC in my wallet and I can move it forward. So defense, we launched support for this on Ethereum and I think OPNets last week, and we're just starting to roll this out as fast as other chains start to roll it out, because it is like just by far like the most requested feature from our customers, and probably the worst part of like the UX experience when you're using crypto is just really, you know, how do I get the funds out of my wallet once they're there?
Yeah, it's a funny dynamic where it's like we've talked a lot about the success of the space, but then when you look at like basic functionality, there's so many upgrades that need to happen in order for this to be useful. Hussein, can you talk about any product or upgrades that you're sort of excited about or you're working on at your company?
Yeah, thanks so much, Matt. I think the big part would be, back again, like to Noah's point as well, like the complexity of basically understanding like what blockchain to use and like how to get access to those assets, and then obviously the whole, even like the terminology of like on-ramp and off-ramp and how to turn this money into fiat and vice versa. I think that's also going to be interesting from experience point of view, like how basically if I get paid, and back to kind of what Carl was saying, like if I get paid in fiat now, how does this end up on chain? And if I'm on chain now, how can I pay my bills and pay my utilities and pay other vendors and my employees as well? So I think actually what we've been trying to do in Limited as well, trying to, I guess, like quote unquote bridge that towards easily, so you can actually go from like on-chain transactions settling in like real time, like for almost for free, to bringing this money back into kind of like the real world kind of slash fiat, and vice versa as well. Because obviously, if you just like offer, back to Carl's point, like everything is on chain, so yeah, you still have to pay your bills, you still have to pay like things, you still have to get paid. So those things are gonna be also like a critical part of it. Like how can you bridge between the whole fiat world and like crypto slash stablecoin world as well on chain?
Yeah, I mean, I've heard that, like, you know, between being able to mint and burn stable coins, you know, sometimes it's up to 5 days in terms of like the timing, and it's interesting. There's still just so much friction moving between these two worlds that exist on that side. Bernard, you mentioned the sort of high growth rate that you've seen I'm curious, what problems, came up and what infrastructure did you guys have to build in order to sort of handle that step up in growth?
Yeah, so with consumers, I do think that you need to abstract the complexity as much as possible, right? With businesses, I would say that they are willing to go through more trouble to get like better prices or better rails, or even go through like the onboarding with banks that usually takes like a month, 2, or even more. So in Brazil specifically, and in Latin America, you deal with a lot of variability in the banks where, for example, you are going to enable a crypto use case there, and if it's January, they love the use case, right? They are doing a lot of volume, but then in February, they're like, oh no, we don't like crypto anymore because it's on the news that now Bitcoin is bad, right? So you actually have, we went through so many cycles. We had another company that did payments with crypto before, and we had to deal with banks essentially sometimes liking you, sometimes not, more disliking you than not. But I feel like that with a business in Brazil or in Latin America in general, trying to onboard with a bank and dealing with capital controls, dealing with the complexity around moving money cross borders in a way that you really don't deal with in the US, even though you deal with some, is insane. I would say that you deal with so many manual processes. Sometimes you have one specific officer of that company that is approving a transaction, and they do it as usual, right? But then that person is on holiday, and they don't have any automation whatsoever. So it's essentially based on the decisioning of that specific person that is processing that wire. So what we built in Brazil to tackle a lot of the problems that we faced before while working with 10, 15 banks, because that was our advantage, right, working with a lot of banks, was that we actually got a specific partner in Brazil. So think of us like getting a Cross River or getting a lead bank when they were like really early on, building a lot of technology around it, having an exclusive, like a partnership where we could leverage that bank and essentially build something that is the best of both worlds. So now in Brazil, we enable users to have a fully regulated license bank where you have the highest tier of regulation. So you can do anything without limitations, right? Because payment institutions in Brazil, like fintechs, if they want to do cross-border payments or even get into like stablecoins, they're capped to $100,000 per day, which is nothing, right? And with the APIs and the amazing operational flows of a fintech. So I think that you really need to either work, for example, here in the US with a BVNK, with a BCB, or with a forward-thinking bank like Leeds or like Cross River. But in Brazil, or in Latin America, in emerging markets, that is very hard to find. And you're usually either going to compromise on limits or capabilities and choosing a fintech, or you're going to deal with a compliance stack that is really suffocating, and with a lack of knowledge of your business model and how payments should be done. So we have actually faced it like really early on in the company, and a lot of our customers actually tell that to us as well, where they would process $20 million in a given month, and the next month they doubled, which, in venture capital, that's amazing. Okay, you're doubling your volume, right? For banks, they shut you down for 5 days until they understand what's happening. Why did you double your volume? And with us, if you want to do off-ramps with stablecoins, if you do on-ramps with stablecoins, you're doing triple your volume, 10x your volume from one month to the other. We will smile from one end to the other of our months, right? So yeah, I think there's a big lack and fear as well when you're dealing with banks and legacy players versus when you're dealing with stablecoin on-ramps and off-ramps and players that really understand what you're doing.
Yeah, I think it's a good point. I think I didn't have a deep appreciation for, especially outside the US, just how manual the banks are at the end of the day. You know, they ask for one piece of documentation at a time, so an FX transaction could take weeks just because they don't ask for all of the documents at once. And how phone-based it is. They don't want to give you the market rates over email. They want it to be on the phone so that they can hopefully squeak out a little bit more margin for themselves.
Yeah, it's like even to build on that, we have portfolio companies that use Bridge. They say it's a great product, they like it, but there's certain fiat flows, certain geographies that Bridge doesn't support. So to enable global assets, and by the way, crypto is a global asset class. Like if you have customers, it's not just targeting one country. If you're an app and you're enabling users to interact with stablecoins, with crypto assets, et cetera, it's global from day one. And that's a new challenge that fintech companies haven't really had to face before. And so our companies are stitching together this stack of they might use Bridge here, they might use Conduit here, they might use this other platform here. Oh, they have a direct relationship with Cross River for this, like fiat on-off ramp. And so I think there's no out-of-the-box product that's completely ready yet. And that's where all of these players are trying to build that end-to-end stack. But even once we have it, the reliability piece is another big one where you're probably going to have redundancy in your system, because the worst thing that would be possible is you're hitting your 2x growth and then your one single point of failure pauses you for 5 days.
Yes.
So we see it as well with a ton of our portfolio companies.
Yeah. And I think it's a good point. The financial system is not set up to grow exponentially. Anytime the banks or the regulators see exponential growth, they get quite worried, even if it's completely legitimate transaction. And so, as you said, you have to have your backup bank and your backup bank to that and your backup service provider, because that's the only way to stay operational through those levels of growth.
Exactly.
So changing to the title of the panel, would love to get everyone's thought. I mean, we were really trying to think of like how big can this space get, and at what time frame is that going to happen? Is really the question that we want to dive into here. And so Noah, we would love for you to start, but I put out sort of the high level of sort of like we're already in the trillions. The question is just how much. And how fast will it grow from here? Is really I think what we want to go into.
Yeah, I think what we're seeing like every day is it's growing nonstop. And the big banks that we talk to, one of their problems is they can support this, right? They can go in, they can go full steam ahead, but they in the back of their heads are like, well, but if I do this, I just ruin my FX desk. Like those traders are gonna be mad. I just ruined that entire all that revenue is lost. So there's got to be some math that they're doing on like, well, what's the NPV of maybe I just keep that FX desk going versus the payments, so they can capture that value, because they know like if they don't do it, somebody else will. So it's definitely like a tough question for them to try to answer, and I think they'll eventually move into it. But
so you're not bullish on the future of FX desks?
If I was at an FX desk, it would be a good time to think of other careers.
Probably to join a company in this conference.
Yeah, it'd be a good time to get into crypto and figure out cross-border payments. Yeah. And I do think like finance it's like electricity. It's going to the path of least resistance. If you can save 1%, 4%, 10 basis points, whatever, you're doing $10 million in a transaction, like you're gonna go save it, right?
Yeah.
There's no reason not to. So I do think like, I think we're past 1% now. I think we'll probably be 10% by the end of the year, something in that range. It's gonna be very high and it's gonna go fast.
Yeah, should I go on?
Go ahead.
Okay, I think actually honestly to Noah's point, I guess like also Carl's point as well. I think also seeing like the Brexes of the world now and like the ramp and like all those guys, amazing success stories, and ironically actually it's like the change from like the American Express or the Chase was like an incremental this is have like a better UX or like a better features and some perks and benefits. But obviously when you look at you compare like a Swift to like a real-time transfer for free kind of thing, that's kind of like where Brexit becomes like a radical change of like actually what is the status quo looks like versus what you can do in a sense. Even one of our customers is like those guys are moving like $1 billion between the different treasury of the company, and it's like we actually pay 6 to 7% fees usually to get this money out, and we were saying like actually it's no bips, it's gonna show up in real time. It's like for them it's like how is that possible kind of thing
Yeah.
as well. And they're even obviously crypto as well, even to understand, comprehend even how does money move from here to here, like in real time for free kind of a thing in a sense. So obviously that's kind of where the radical change is incredibly to see like that opportunity. Hence kind of why it's not going to be surprising back to Matt's point, like the title of the panel, like how can this eat away a significant part of the traditional payments, given how radically better this is as a chapter versus the traditional kind of old school of doing things in a sense.
So technological adoption is always nonlinear. Like there's very few technologies that are adopted in a linear fashion. It's slowly than all at once. So we assume that stablecoins fall into that same bucket. The question is more, at least to reframe it differently, it's almost like what would stop this nonlinear trend from continuing? And there's a couple different things, but I think all of them are extremely low risk to zero. So like one obvious one is regulatory. And we've never seen a more bullish regulatory climate, a pro sort of stablecoin unified front across both Republicans and Democrats. And so like the Genius Bill, the Genius Act itself is one of the most important pieces of legislation that is getting pushed by Congress at this point. They know they won't get reelected if these things aren't being passed, so everyone's highly focused on it. And the U.S. strategically sees the dollar as critical to maintain U.S. dollar supremacy globally, and that's certainly something they're going to keep doing, and they have to do in order to have somebody that's a net buyer of bonds on the back end, right? Because otherwise, who's going to be buying U.S. bonds? Well, if they're holding dollars backed by bonds, then that makes it a lot easier. So, like from a regulatory point, I think it's very low risk. Things are going. You couldn't paint a better landscape from a regulatory point of view. And other countries tend to fall in line to the U.S. regulatory climate. Technological is another major risk that could happen to stop a nonlinear trend. But again, we have hundreds of millions, if not billions of dollars going into payments solutions and payments companies. There's a lot of really smart teams and major companies that are working on this, so almost no technological risk. And the last one would just be market/product risk. Like, is the market want this? And very clearly the answer is yes. Once somebody's in an emerging market, for example, and they start getting stablecoins, they just live in stablecoins from then out. They're not like going back to fiat. It's like, so once money goes into the crypto system, it stays there. It doesn't go out as frequently. I'm curious if someone else can corroborate that based on data, but that's just the use case that I've seen across all of my touch points. And so very low risk. We don't continue to go exponential growth on the stablecoin and more broadly the crypto side.
Yeah, I mean, I would only add one, which is just that connectivity between the fiat and the crypto world. It has still been a weakness in the space, and like as we continue to grow these volumes, like I think a lot of companies are focused on sort of improving that piece as well.
Totally.
Because
But like think about it 2 years ago. Like the only way to get money in and out was basically to go to the crypto exchange.
correct.
Like that was your only solution. That's why Binance is one of the largest stablecoin payments platforms out there, or at least networks out there. And now we have Bridge, we have Conduit, we have all of these companies run by sophisticated executives, backed by sophisticated investors, and I think we're just going to continue to see a groundswell of companies eating at this massive market, knowing that trillions of dollars are going to go on chain. How much of that pie can any of these companies capture? That's the number one goal. So I agree with you, but even just reflecting back a couple of years, the amount of focus on it has been incredible.
Yeah, so I definitely agree. I think that to your take, FX will probably go on chain, or at least a good chunk of it. We already seen that in emerging markets in Brazil. Supported by data, we are close to 10% already. So I would say anywhere from 6 to 8. We were talking about the data globally, right? My take is that we are anywhere from 1.5 to 2.5% of the global cross-border payments. So not necessarily payments in general, right? But maybe the title of the panel is we already passed it, right? We already passed 1% of the cross-border payments for stablecoins. And I think that with more emerging market stablecoins coming and you actually having convertibility, liquidity between a BRL stablecoin with USDC, USDT, USDG, and now having also like a Turkish lira stablecoin having actual liquidity and demands and distribution, then I don't see a reason why you would still use the interbank system to trade currencies when that's 9 to 5. You have to have a counterparty there that is usually going to be very unreliable, and also you're going to take 3, 4, 5 days even to get the money across. And moreover, when you count the weekends, right? If you're sending money in Brazil on a Wednesday to Hong Kong, it's probably going to get there on Tuesday. So it's definitely more efficient, it's faster, cheaper, better in a lot of occasions. I do think we had a lot of hype around it as well, so a lot of companies actually came to us and said, hey, I want to use stablecoins, and their use case, maybe it's not cheaper there, right? Or maybe it's not faster there. And they assume, because it's like very hyped as well, that stablecoins are always better. I do think that in some cases, it might be cheaper, right, to still move it through Swift. Because there's a big misconception on Swift that Swift takes long. It's not Swift in itself that takes long, it's the model, right, with corresponding banking, with so many points of failure. So Swift in itself, it takes a couple minutes, if not seconds, right, for the message to arrive in the other bank. The problem is that someone manually, most of the times, is there to like press buttons and approve that transaction, and you have many banks in that chain to actually settle payments from Brazil to the US, for example. So I do think I'm actually very happy. I think that we are in the closing panel, and I think you share the same idea as me, that I'm super excited with what we are building together. I think it's not a winner takes it all. We are building a huge pie, and we are really changing how payments are done globally. And I think that now companies are building out the US like payment systems, and then you have like the European ones, you have the Southeast Asian ones, and they are all collaborating. So as you see in payments as well, right? You have dLocal in Latin America, then you have like TazaPay in Southeast Asia and so on. One uses the other in each region, right? And we are seeing the same now. So we power conduits in Brazil, we use conduits in the US, we power like dLocal in Brazil, we would use dLocal in other countries as well. So it's very collaborative. Although you could even clash in a specific geo, for the most part, you're not going to clash in the main regions of each of those. So, and again, to your points, I think having a common denominator, which is the USD denominated stablecoin, you'll have so much more flexibility, and you don't actually need to, okay, I send money to my US company, now I need to talk with my US bank to send that into Hong Kong. No, you can actually just get your USDC or USDT, whatever stable you have, and settle that across the roads, and you just liquidate that there. So it's simpler, better, for the most part, cheaper, faster. So yeah.
Yeah, so I think this panel, we believe that there's tens of trillions of dollars that are going to roll onto these rails. As we sort of squint to the future, and if we're having this panel next year, maybe the year after, I'm curious, like, what do you think the problems are, not today that we're dealing with, but the problems in the future? Is it going to be new types of stable coins? Is it going to be new functionality? I mean, we have obviously some that pay yield, like Mountain and One Money. Are there going to be, stable coins backed by CDs or corporate bonds? I'm just curious what you guys, as you try to look out 3 to 5 years ahead, maybe what you think is coming.
Yeah, I definitely think the yield-bearing stable coins are going to take over. It's just money on the table. Love Circle, we hold quite a bit of USDC, but at the end of the day, that's money that the consumer wants. Or the business, whoever's using that. So even if you're only holding stable for a day or two in the middle of like a remittance, you're still going to want that yield. So I definitely think we'll see some more evolutions in how that yield's going to go through, and we'll also see kind of that value chain go back to the business, to the consumer, to whoever's really consuming that. And know, we think about like, yeah, like in the U.S., you know, maybe my ACH transfer is free. Well, it's really not free, right? Because your bank is taking all that yield from you, and you know, in this case, like you get that yield on chain. So I definitely think corporate treasuries are going to move over. You know, everybody, why not? And when we look at USDC and Tether, I think it's over 100 billion on chain right now. Well, imagine that all yield bearing, and yield bearing on chain, it's going to yield quite a bit.
I think for me, actually, honestly, speaking of like the risks possible as well, it's I think ironically because it's still not that big market share, it didn't alert kind of the countries, governments back to consummate like the central banks and all those guys. So actually, it's gonna be interesting to see like yeah, if this becomes like 10, 15%. Now they're, which is actually obviously back to the US, like it's smart obviously to put your USD on chain. You're selling US debt out to everybody and they're happy buying it kind of thing to get this USD access. But then obviously what happens now to the Argentinian government, to the Turkish government, to the Egyptian government, like how those guys can react if they're losing control over this currency kind of thing, because they can't really print more of it, they can't really dilute it, they can't inflate it if they need to in a sense. So it's gonna be interesting how the country's probably gonna be react from this. It's gonna be BRICS taking over or like some other like digital kind of central bank currencies joining that race, especially once this like 1% becomes double digit in a sense that actually now it's scary / kind of impactful to government economy kind of thing as well. So that's going to be interesting to see how that plays out as well as this kind of comes into double digit growth of market share.
Yeah. Carl, any thoughts?
Yeah, I think it's going to be a race for users. Like we're on a panel next year. It's who is going to be the first to the user. It's funny. I used to work in smart home at Google Nest, and it was in the 2020 era where everyone was trying to get a speaker into your home. It was, is it going to be an Amazon Echo or a Google Nest device? And it was like, we have one opportunity to win this household, and we're going to give a cheap price to go ahead and make it happen. And so I think you're going to see the same type of land grab in the stablecoin space. So you're going to see this at least on two different fronts. One is on the credit card / debit card side. I think it's incredible that today we are creating on-chain payments volume from users swiping debit or credit cards that are collateralized by stablecoins. And so you think about it, you know, Visa and MasterCard are not going anywhere over the next year, but crypto is now part of that payments flow and that settlement reconciliation process that it never was before. So it's how do I get, so it's going to be which issuers are going to be having cards that create really great experiences for users for especially emerging markets where they can now get access to credit and debit, put money on the card and swipe instantly. So I think that's just going to be a growing area, and generally e-commerce and credit card usage / debit card is just growing exponentially globally, and that's just going to continue. I think the other one is on the, I'll say, crypto bank or the neobank side, and maybe even for the traditional banks. I think the days of me having a Bank of America account, spending $25 to do a wire, like those days are pretty much over. Like stablecoin eliminates those like instantly. So the question is, people are going to be moving their money to where they can get the most value for it in terms of yield, in terms of features, in terms of experience. And so there's going to be a lot of user deposits switching from one location to another. And so I would expect that to be a core area where you're going to have a bunch of major companies talking about their strategies to win the next 100 million, 200 million, 1 billion users globally.
I agree. I think that now we are, as with any disruption in markets, we are at the exploring stage where you have like so many companies tackling this, but I think that we will of course have consolidation, like companies acquiring others, like smaller mid-sized companies. Moreover, I think that with borderless network, with CPN, with those types of consortiums as well, like the global dollar network, we will see more concentration in some of the players because they will have a business model and unit economics that allow them to be more aggressive as well. So I think we will, over the next few years, see a smaller number of companies that will tackle this, because otherwise you will have, let's say, on-chain effects, right? And margins and fees will of course improve because now you can go into many options versus actually having to only bank with Bank of America, bank with Wells Fargo and so on, which is a good thing because now, as it happens with open banking as well, you have like more optionality for the users. But at the same time, I think the players that are as close to the core infrastructure are the ones that will eventually prevail and have the next $1 trillion being moved by them, right? So if you want to build the next RoadPay, if you want to build the next dLocal, if you are planning to move money for large enterprises and being able to take a good chunk of this market, you should probably own at least one of the countries or one of the regions. Otherwise, you will probably eventually only service the last layer.
Yeah, I think it's what I've seen is it's going to be a barbell strategy. So you either want to own the customer or you want to own the infrastructure. But everyone who's in the middle, if you don't own the customer or your infrastructure, I think it's going to be very, very difficult to survive.
It's like in crypto. We say right now the two best businesses are issuance and trading. So those that are minting and creating the assets, and those who are the front page where they're being traded. Those are the two best business models right now in crypto. If you look at Hyperliquid, you look at Pump.Fund, these things that are generating hundreds of millions of dollars a year in revenue, issuance and trading. And so to your point, it's exactly going to be the same way. Who's minting the stable coins and doing the back-end close touch orchestrations, or who has that front page of the user and can get the attention there?
To your point about credit cards earlier, I think it's going to be when somebody actually goes on chain with it. And when I say on chain, I mean like for real. Like MasterCard, they went through MoonPay, through Iron, which is then backed by Defense. So, glad to be a part of that value stack. But really, it was just using a traditional rail for MasterCard. Like they weren't actually doing anything on chain. So I think when we see them really go on chain or somebody compete against them in that same like value stack, that's when we'll really see that, total user adoption.
Well, great. Well, please give a clap for our panelists. Thank you guys so much for the time.